All right. Hello, everyone, and welcome back to the Investor Financing Podcast. And I'm your host, Beau Eckstein, and we have our guest back, Carey, our in-house SBA guru, who's going to answer all SBA questions, or he'll get you the answer if he doesn't know it. But he's been doing it for close to 20 years, about 15 years, I believe. Been in the SBA lending business. So he knows what he's doing. He's worked on the SBA 7A side, but now he's focused on the 504 side. That's what he really loves to do. And we're going to dive in on this episode specifically because Carey's specialty, amongst many things, is self-storage. And we're going to talk about self-storage financing, buying an existing self-storage facility, and then also the difference between what you're going to need to build a self-storage facility. Utilizing the SBA 504 loan, we'll probably drop in some clues about 504 greens if you're doing some bigger projects and you need to get more SBA bandwidth. So let's kind of retrace. And everybody, I'm going to link somewhere in these videos. You'll have some links to our previous conversations we had all about SBA, because I think those were all very useful. We've gotten a lot of compliments. Carey's gotten a lot of calls. I've gotten a lot of calls. You guys feel free to give us a call. We're going to answer your questions as best as we can. And Carey always answers his phone. I usually always answer my phone. And for a banker to always answer his phone, first of all, that's a really good banker, because a lot of bankers I deal with don't answer their phone. So he's very, very responsive, which when I first met Carey, that's the first thing I noticed about Carey, is that he's responsive and he cares about your deals. He cares about you. And so that's important. One is always to have a good relationship with somebody you're doing business with, and for somebody that's very proactive, because a lot of people, I get a lot of complaints from people that have sent in a file to another bank or lending institution and they don't get any feedback. Carey, at least he's going to tell you, hey, this looks promising. And if he can't do it, he's going to tell you right away, and he might have some resources for you. But Carey really focuses on loan amounts of $3 million and larger, total loan amounts, SBA loans, and they're really good pricing. They have some competitive advantages in the marketplace on the SBA 504s, and they're very fast turnaround times, which is important in SBA. But without taking too much more time, let's just talk about SBA and why self-storage might be why the 504 loan might be a good option for self-storage, whether it's a stabilized property or ground up construction.
Well, Beau, it wasn't until 2010 that SBA actually allowed the financing of self-storage. They first viewed it as a passive investment, but from 2010 on, the SBA has allowed financing of self-storage as they saw it as a viable investment for entrepreneurs.
And that really opened up the door to a lot, because where else can you get really good financing, high leverage, like SBA financing? Now, borrower meets all the credit boxes. Maybe they're a W-2 employee at the time. They want to buy their first self-storage building, existing with cash flow. They don't have experience. They're going to have the right, maybe employees on site and so forth. How does the underwriter look at that? Well, first off, Will they cap it usually at like an 80%, or will they go to 90% because it's a cash flowing business already?
In that loan scenario, as long as the property has been in existence for over 2 years and it cash flows, and hopefully the borrower would have some kind of business experience, either management experience, retail experience, but he could actually hire a management company to run the facility and still be able to get or purchase the facility with 10% down. Now, the management company, their agreement has to be approved by SBA. The SBA's main concern is they don't want the management company to have too much control. And usually the smaller management companies, if their agreement is not approved by SBA or is not SBA compatible, they can modify it. I know of a couple of companies that we've worked with that I've closed deals with where their management agreements are approved by SBA.
That's very good to know. So you can get 90% leverage. And when we say 90% leverage, you're also able to finance some of the closing costs and the SBA fees within that 90%. So it's really, where traditional loans, you're not able to finance those certain costs. Can you kind of explain what costs you can finance within this 90% loan to cost?
Sure. Obviously, the third-party lender fees can be financed. That's the appraisal, environmental, title, everything. And then each bank has their own fees that apply to the loan. For example, like 1% origination fee, and on every 504 loan, we have to pay the CDC a half a point as well. All of those fees can be financed into the bank first lien. And I know we've talked about this in a previous podcast before. The CDC piece, we do a bridge loan for. And because it takes 60, 90 days after we close both our bank first lien and the bridge loan before the CDC can close. Any fees involved with those two loans can be financed.
Okay, now let's kind of walk back on a scenario. A buyer wants to buy the debt service coverage is still there, might be a little weak, but there's a large value add component, and they want to include some CapEx, some repair renovations into the budget, and it's their first self-storage. Assuming that the debt service coverage ratio is in line, can we finance 90% of total costs, including repairs?
Would have to give back to, like, say, a management company again, or a strong consultant in the industry, because hopefully those improvements would increase occupancy, and then either their CPA or the management company or a consultant can prepare some projections, and then that would be key to whether a bank like ours would like that loan, just based on the projections and the assumptions for those projections. For example, a borrower could. I had a recent deal where the smaller units were selling faster than the bigger units, so he got extra cash or extra loan proceeds to convert the larger units into smaller units. So improvements like that could help increase occupancy.
Wow, that's good. So there's options, and I think it's really there. You know, what I hear Carey saying is he can, when you're giving him these scenarios, he's going to help structure. He's going to give you pointers on, you know, how to get the deal sellable to the underwriter to sign off on it, essentially. So what he was saying is that, yes, you can potentially finance the CapEx or the value add component, the rehab of the self-storage, but you're going to have to show that extra, let's say it's $500,000 of renovation or CapEx, that additional proceeds is going to add increased occupancy, which in turn will increase revenues to support the loan balance.
Another example is I'd had another deal where they converted regular units to climate controlled, because there was more of a demand in that market for climate controlled self-storage as well. So that's another scenario.
Because we often see a value add type of deals, investors out there that are doing self-storage, they come and they found like something that's mom and pop owned, and then they want to bring technology into the self-storage facility, different like keyless access and so forth. So those sometimes would be a good fit for SBA 504. A lot of investors sometimes will buy it with bridge money because they want to do the value add and then refinance with SBA would be an option as well. But if you could do it all at once, the best cost of leverage is an SBA 504 loan on something like this. So compared to like doing it in two steps and having to refinance, you could do it all in one loan, or actually two loans. Let's talk about, I get a lot of questions. Like today I was on a Zoom call, and everybody that's doing some kind of value add component or construction, they kind of have the idea, like they understand a little bit about SBA, but they got to kind of grasp this picture is that SBA, if you're doing any kind of construction, that you need permits and plans, everything pretty much queued up before SBA is going to fund the loan, right? On any type of construction loan. Because, for example, I had a guy today who wants to buy a restaurant, but he needs to do $300,000 or $400,000 improvements or remodeling. He can't finance those costs unless there's plans, there's permits, there's a GC that's been signed off by the lender. I mean, do you run into that commonly, like where people are doing, like they want to buy land and they want to build, but they have to understand they have to be pretty much shovel ready before SBA will actually fund the loan. Is that pretty accurate?
Well, unfortunately, COVID has really messed things up as far as construction goes. It runs the gamut, Beau, where one municipality, it may take 6 months to get a building permit, others 30 days or 2 weeks or whatever. So every time, personally, when I start a construction loan, the first question I ask is, where are you at in the process? Have you got a GC? Has the general contractor applied for permits? So we do like to see it in place before we start the loan process. Now, if they tell us that we've applied for permits and it's going to take 2 months, in a situation like that, if they've got a strong budget from the contractor, we can move forward. If we know by the time we close that we're going to have permits and everything, then we can start the loan process.
Yeah, I guess the point I was trying to stress to the viewers is that we can't close an SBA loan or construction loan without all these pieces in place. So oftentimes people think, oh, well, I can acquire the land and then I can get financing, but all the pieces have to be up front, we don't close on the land and then you get the financing. It's all in one. So you have to, if you're going to be buying something that you're building, you're going to have to either do an extended escrow period so you can get your plans approved, or pay cash or get a loan on the land. And then when your plans are approved, then you would utilize an SBA 504 loan at that time.
And also, I had a deal where they had previously purchased the land, and we were able to refinance the land into the new loan. So, they can buy the land ahead of time.
Yes.
If somebody's going to build a ground-up self-storage facility.
Yeah, because a lot of people call me and they're like, just thinking about the idea of buying a self-storage and building a self-storage. Well, that's great. And I think the number one thing to do is, if you can tie up that land and give you enough runway to get plans approved prior to you closing on the purchase, then you could put an SBA loan in place possibly. And that would be the easiest. Or if you have cash, you can close with cash and then potentially refinance with the SBA, just like Carey talked about. But you have to have made progress. It's not like you can just buy a piece of raw dirt and then close on it with the SBA. You have to have an entitled property. So I just want to stress that, because a lot of people don't realize that's how it's got to work. So when you're writing an offer, you got to know, hey, well, it's going to take 2 months it's going to take a month to get my architect, it's going to take another 2 months to get approved. So I need to write a 5-month purchase agreement. I close in 5 months versus I close in 30 days. So just so the expectations are realistic for everybody, because you have to have all these pieces dialed in for the underwriter, who's the GC, their resume, their insurance, all that stuff. That all has to be dialed in. But that's, if it's a 2-month process, that's what Carey's facilitating with you during the process. But if you're just way out there, you're not going to you can't get a loan approved. You can get some good feedback, but that's the reality of it. You have to be at that point. So, diving back into self-storage facilities. The other reason, now, if you're an existing owner of a self-storage facility and you're now want to go build a new one, and you've got 2 years at this location, you're going to keep the location, but you want to go build in another market. You have the experience now and the cash flow, let's say, from your existing business, where you can get, that's not considered a startup at that point. So I could potentially get 90% of total costs on a brand new construction project.
That is correct. And in some cases, you may be able to use the equity in your existing building as the injection for the new property.
How would that be with like a cross collateral?
Every deal is case by case, but there's some, let's say there's existing debt on the current facility. And depending how the corporate structure is, if there's different LLCs, they can be co-borrowers on the same loan. And we would refinance the debt on the first property, then use that equity for the new facility.
Got it. And collectively, because the people that are doing self-storage, SBA guidelines say you can have out up to $5 million in SBA financing. So that would be just the second mortgage lien. You'd have on a 504, if you did $1 million, you'd have a $400,000 second lien. So you could have up to $5 million essentially in collective SBA loans, not counting the first senior bank loan, but actually SBA loans. But if you grow too big, you can also incorporate the 504 green, which lets you have 16.5 million collectively of SBA, which is like 40 million of buying or building power collectively. So there are ways to really grow. I mean, you can really grow quite a business with SBA by utilizing SBA with this self-storage business.
Oh, that is so true. And banks love self-storage facilities. I mean, it's just it's low risk. Most of them, if you have a good operator, most of them cash flow. So they're very good in a bank's portfolio, self-storage.
So let's rewind a little bit. We had talked about somebody that didn't have experience, had a business experience, but not business experience with self-storage, but they want to build a ground up facility. Is that usually going to cap them because it's at 80%, or if they have a management company already dialed in, could they potentially get 90?
They could. Well, let me think about that for a second, because that's going to be a startup. So that would be 15% down. That would be considered a startup. So if
it's 15% down for startups, now it's 20% down if it's like a special purpose type of building, right? Like a 20, and it's a startup.
That is correct, but self-storage is really not considered a special purpose property. It is, however, I think there's if it's cold storage and like over 50% cold storage, that is considered special use. But just dry self-storage is not considered special use.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
Hi, this is Beau Eckstein, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. Do you guys, is cold storage actually SBA financeable?
It is, but it's considered. I think the cutoff, if it's over 50%, that is considered special use. But it is SBA eligible.
Okay, good to know, because I have a list of a lot of. I didn't know that. Okay, well, I probably could have assumed that, but I just never thought about it, I guess. All right, so let's kind of put all the pieces together. So if you're buying an existing self-storage facility, what you'd want to get is 3 years of the seller's tax returns and a year-to-date interim financial statement.
That is correct. And
rent roll.
Rent roll as well. And then, of course, that rent roll should show the occupancy. And the rent roll should also show the various sizes of units and how many they have. So that normally that's all included on the rent roll.
Okay. So from there, then for sizing these deals up, we know we can then pretty much figure out what our loan proceeds would be. And Carey can run a quick analysis to see if the cash flow would debt coverage the new loan for the buyer, right? So a buyer comes in, you always got to remember that on an SBA deal, and correct me if I'm wrong, that for underwriting purposes, they always need tax returns of the seller on the business.
Yes, because those are considered the source documents, and it would be great if we could underwrite off financials, but tax returns are considered source documents because they're sent to the IRS. So and normally CPA prepared.
Yeah. So there's no way of just getting a P&L to close the deal. You actually need tax return.
Yes, correct.
Okay. And the other thing too is, like, if you have on your financials that the seller gives you, you got to make sure, because I ran into this problem before, was the seller had commingled P&L with his other property. And that, like, he had, both of them were in the same P&L, and that's a no-no. You have to have them all separated. SBA will not like seeing a commingled P&L. Like, It was a assisted living, and he had one P&L for two properties, and it was like,
Okay.
yeah, and I couldn't get it funded because I could have funded it, but they needed to separate the P&L for each of the healthcare facilities.
Exactly right. And if it's consolidated tax return, like you just spoke of, Beau, an underwriter is going to want to see, of course, financials for the property that's being purchased, and then the financials for the other property, so they all tie to that consolidated tax return. So as long as all those sets of financials and tie to the consolidated tax return, normally that's okay.
All right. So now we know we need 3 years of 3 years and a year, 3 years of business tax returns from the seller and a year-to-date statement from the seller on the P&L. For you, the borrower, you need 3 years of personal tax returns, 3 years of business tax return, and a year-to-date statement on any businesses that you do have. You basically need a couple other forms would be a form 413, which is a personal financial statement. Any other businesses that you have, there's a debt schedule form you have to fill out, a resume, and what else am I missing? That's for initial sizing. That's pretty much what we need, right?
Yes, and that list of documents may sound complex or whatever, but
it's easy.
Exactly, because like what I do and what most banks do, well, they have a short checklist of items needed to do an initial credit analysis, and but initially that list it's probably 7-8 items, 7-8
Yeah.
things.
Yeah. Actually, I use this new system, and I have it all like the form 413, and it's all there. I just email it right to the client. I got to show you what I do now. It's so slick, and then they upload it right back. But anyways, it's easy. It's not complicated. It seems complicated when you first think about it, but the SBA process isn't complicated. Now, okay, so Carey gets the financials back. So we have an initial conversation where you call Beau, and Beau says, okay, let's call Carey after I hear the deal. I said, Carey is the best fit for this deal. We set up a call with Carey. Maybe I have some information that we share with Carey beforehand. We have a conference call. We talk about the deal. Carey looks at the financials of the property. He figures out the debt coverage is good, that the property's cash flow will support your loan request. We know you got good credit. You got good financials. Maybe you're a W-2 employer or whatever. Your financials are good. Then Carey sends the rest of the checklist. He submits the file to underwriting. Typically in 5 to 7 days, they come back with a loan commitment. From there, Carey's already engaging. Once you look at the loan commitment and want to move forward, you sign the commitment. But at the same time, Carey I work with a third party that is the nonprofit that essentially works with SBA, which is called the CDC. On an SBA 504 loan, there's two pieces. There's the bank piece, which is the first lien, and then there's the CDC or the second lien. So on a 504, there's an underwriting process done by the bank, and there's an underwriting process done by SBA. So in conjunction, once Carey packages up, he gets a CDC involved, or perhaps you already have a CDC involved. It's probably better to use a resourceful banker that's got really good relationships with CDCs, just because they mesh well together. It'll just flow better. So it's usually better to go to a Carey first than go to a CDC, just my opinion. Because the biggest piece of it is making sure you got the bank lined up beforehand. So once the file is underwritten from Carey's bank, the CDC gets it, they ship it to SBA. That takes 3 or 4 weeks, depending on how busy they are, maybe longer. And then they come back with their approval, right, Carey? So then your bank knows that CDC has approved it too. So then Carey's bank works to get all the prior to document conditions ready, whatever those conditions may be, the appraisal, third-party inspection reports. And then loan documents are prepared. The borrower signs the documents, right? Okay, and then the deal is funded. So at this point, SBA hasn't really gotten involved. They don't fund the deal, they actually guarantee the loan. So the CDC hasn't yet bought the loan yet. So Carey's bank is funding the first and the second loan at this point. Once the deal is recorded and closed, then what happens is there's a debenture that happens anywhere from 30 to 60 days, usually after certificate of occupancy. You're buying a stabilized property, so there's no really certificate of occupancy. You already have occupancy. So the debenture would essentially happen between 30 to 60 days of close of escrow. So you actually have your second loan in the beginning is actually like an interim bridge piece. It's not the SBA piece at that time. But after the debenture happens, that's where that second lien becomes a fixed rate, 25-year fixed rate at whatever the rate is. Today, the rate might be 3.07, straight 25-year fixed rate. And that's 40% of the total loan amount. Carey's bank retains the first lien, the senior lien, and that's 50% of the total loan proceeds. So that's 50 plus 40 equals 90% of total cost. That's how we do it. So the banks like these type of loans because Carey's bank, then after the debenture happens, they have a 50% or less than 50% loan to value loan. So it's very secure for them. The SBA is guaranteeing the CDC or the CDC's investors, they're guaranteeing a certain percentage of that loan. So those investors like it too. So the SBA is continuing to grow, especially over the last 2 years. There's doing more volume now than ever before. And I believe it's going to continue to grow as more and more people want to start businesses, want to grow businesses. But did I do a pretty good, accurate job there, Carey?
You did, Beau. And one reason for the growth was all the incentives that we had last year, the CARES Act incentives. However, in the case of 504s, the refinance guidelines were recently enhanced, and I think they went into place like July 29th. For some reason, that date sticks in mind. So 504s will expand too, just based on the new refinance guidelines that were put in place.
Yeah, because now you can also refinance. You can refinance a SBA 7A into a 504. So you go from a variable rate loan, which is based on Wall Street Journal index plus your margin, and it's typically a floating rate somewhere in the sixes right now. You can actually, if you qualify, refinance into a 504. And on a 504, the second piece is a 25-year fixed rate. Commercial banks, if you ever have looked at commercial financing, if they offer a 25 or a 30-year loan, it's typically not fixed for 25 or 30-year loan. Commercial loans are always fixed for 5, maybe 7 years, and then they go adjustable. So the senior piece, like a Carey's bank, for example, it would be a 6-year or a 5-year fix, amortized over 30. Not all banks do 30-year amortization, which is huge for cash flow, right? The longer the period of the loan is extended, the shorter the less expensive, or the more the loan's extended, your monthly debt payment's less. And if you're looking for cash flow, we always look for the longest amortization possible.
And Beau, that is correct. And for example, our bank, we do offer 30-year amortization. And also our rates are good too. So those two components combined, somebody who has a real estate 7A paying a high rate at a 25-year term, they could significantly lower their payments. So yeah,
self-storage is kind of a given. If you're investing in self-storage, if you own and operate self-storage, or you're looking to get in self-storage business, it's probably a lot easier if you're looking to get in the business to actually buy an existing business with cash flow. I think the opportunity right now, is to buy mom and pop businesses. They're going out of business or they're retiring. And I think there's a tremendous opportunity for investors that want to run their own business to buy self-storage right now. So that's, something to look at. I get a lot of calls for financing, and there's a lot of upside on those businesses because they were been run by, husband and wife or whatever for 20 years, and they don't have the best technology. Maybe they're not marketing it correct. So I think there's a huge push for self-storage with people out there, investors, and you can use technology to kind of it's a little bit more passive, where you don't have to be hands-on as much as you used to in the olden days. So it's a really good opportunity, and to be able to connect in with kind and get, some of the best, highest and best financing terms out there. It's just kind of a no-brainer if you can, if you kind of meet the boxes for SBA financing. Typically that's 680 credit score or better. You probably have to show some security, meaning some assets and so forth. They're looking at you kind of holistically as the strength of the borrower. I don't know how much like current income has to play if I'm buying a self-storage facility, and I make 30 grand a year as a bus driver, and I'm buying a $2 million property or $1 million property. The credit worthiness still has to be there. How much weight are you going to put on the actual borrower, like their financial picture, like their net worth, so forth, Carey? Like, that's kind of a good question. Like, if they're a W-2 employee, maybe they're make 50, 70, 80 grand a year. They have the 10% of costs and a little bit of reserves, but that's maybe they own a home. SBAs, they're pretty liberal though. I mean, as far as what are they going to look at the borrower? I mean, obviously using the cash flow from the business, they're more looking at the cash flow of the existing business versus me personally. I mean, they're going to look at my credit worthiness and stuff, but how much weight do they put on reserves and all the other components?
Well, Beau, every deal is case by case. And getting back to your example where the bus driver making 30 grand a year, we would hope that his wife's an attorney or a doctor or something to have that extra income. I'm just kidding. But anyway, like I said, every deal is case by case. And I mean, getting back to the bus driver again, maybe he has a family member who can come in as a partner or something that has a strong net worth. I mean, that might be a situation where they could bring in a family member and make the deal more solid. So there are so many different ways to structure the deals based on, and you're right, the reserves are important. Outside income is important. So we would hope with a borrower that has limited net worth and limited liquidity, they could bring a family member or some kind of strong partner into the deal. Yeah,
Carey and I were working on a deal, and I watched how creative Carey was. For net worth, bringing in like potentially like a family member's gift. I mean, Carey's going to get the whole thing about lending is like, even if you're not quite there, what can we do for compensating factors, right? Like, maybe your net worth's not there. Maybe you find the right partner. Maybe there's a portion. Maybe you get the seller to carry back a portion to lower the loan proceeds so the debt coverage is way higher. There's just lots of creativity, and actually SBA, they're pretty flexible. I mean, they're not for certain things, but if you can mold a deal, they're trying to help small business owners essentially the best they can. I think so.
And that's the goal of SBA, Beau, is to grow entrepreneurship and to help those folks who can't get a loan at a local bank or something. So I always say, because I guess because I'm biased, but 504 loans are the best commercial real estate financing available out in the market today.
I like that. That was good. We'll probably have to edit that and put that in the front of the video. That was a good.
Right.
So as we're winding down here, and guys, we're going to be doing a segment I just talked to Carey before that we got on air, and I said, let's just do one segment a month because people love this stuff and Carey's a wealth of information. But some key takeaways on self-storage deals, any kind of things that people might, any points if they're looking at buying self-storage, any red flags to run away from, other than, obviously if it's not cash flowing?
Well, we've already touched upon it, but self-storage is one of the few industries where somebody who doesn't have that specific experience can actually get in and purchase a property with 10% down, as long as they've got a good solid management company where the management company's agreement is approved by the SBA. So that's very few industries would allow somebody with no experience to come in and buy a property like that.
That is great, by the way. The more I think about it, because like, for example, like when people are trying to buy multifamily property and you try to get a Fannie or Freddie like agency for a big multifamily, I'm talking, 20, 30, 50 units. They will not make a loan unless you have own similar assets. So that's great that SBA for self-storage, because that, a lot of people are looking for businesses to own, and self-storage would be, ideally would be the right business because it's potentially could be less, less hours worked. Like there, you could do a lot of stuff remote. So I think that was a great point, but go ahead. You were going to say something else.
Oh, I lost my train of thought. One thing we didn't talk about is I have a client who's an experienced operator, and he seeks out properties that aren't cash flowing. This could be due to several reasons. The owner's going to retire; he's not marketing or anything. And in one case, he was renting out a bunch of units to family members, so we didn't get any income. And this client of mine will purchase these properties and turn them around with his expertise in marketing and everything. So that's another case where self-storage, once you become an experienced operator, you can look for those opportunities like that.
Yeah, I like it. I love it. Well, Carey, thank you again. We'll have to discuss what our next topic will be about, but self-storage is definitely a hot topic. And I think people that find this on YouTube or through my newsletter are going to find a lot of value out of it. So I appreciate your time again.
Oh, Beau, once again, I appreciate you inviting me to these podcasts and getting the word out on 504 loans.
Yes, thank you. All right. Well, maybe what we could do is bring on a CDC lender next time and have Carey, myself, and a CDC lender do a little 504 day and talk all about the CDC, how they work with the banks. I think that would be interesting for people too. But we'll talk about that. Yeah, thank you. All right, everybody, please like, subscribe. And if you want to book a call with me, I will have a calendar link. I will put Carey's information down below as well. And thank you for being a loyal fan of the show. See you guys next time.
Thank you. Thanks, Beau.